your screen. All good?
We're good.
And if I hit page down, we're advancing, right?
Yep.
Great. Okay. So just to level set expectations on today's presentation, most of you who have seen me do this before, I'm guessing that is indeed most of you who are here today, know that I present a lot of metrics on the market, and then I sort of just tie it up at the end with, connecting the dots of, where are we at and where do I think we're going. This one's going to be more macro heavy. By that, I mean heavy on the larger macroeconomic variables that are driving the housing market, because that's what's happening right now. Those are your drivers. Um, I say that because, in contrast to, say, the previous housing downturn, which was the one immediately caused by COVID when everyone was quarantined, that was a very sharp but very brief recession. It was measured in months, not years, back in 2020. It was COVID policy that was driving the market. And before that, during the housing bubble, that relationship between the economy and the housing market was inverted. Rather than the economy driving the housing market, you had the housing market driving the economy. So back then, my presentations were very heavy on housing's fundamentals, things like population and rents, and whether or not they could support the price appreciation we were seeing. And of course, they couldn't. Right now, the main focus of every economist, whether they're focused on the real estate market or whatever they focus on, is on the larger macroeconomy, because that's what's driving things. In particular, interest rates and the uncertainty around that. And then, of course, the big one is Mr. Trump's tariffs, and what they can be expected to do. And of course, it's been a very, very bumpy week. We had the tariffs implemented, the stock market plunged. Then, of course, yesterday he gave a 90-day moratorium on all the tariffs for almost everyone except for China, which he increased. So I've had to put together this analysis as rapidly as I could in response to a rapidly changing situation. I was up quite late last night and even up early this morning doing it. But I'll be sharing with you what I think we can interpret from the uncertainty around interest rates and the impact of what tariffs might be on the economy, as well as the housing market. So you're going to be the first ones to see this. So would love to hear the feedback on it. So without further ado, let's jump into it. So um, let's start with the macroeconomic drivers of the market. So on the demand side, population is one of the biggest ones. Here we have cumulative population growth going since 2000 in Philadelphia, as well as our comparable metropolitan statistical areas, MSAs, here in the Northeast Corridor. For those of you that don't know the acronym MSA, it basically means a city plus its suburbs. So the Philadelphia MSA is Philadelphia County, plus the collar counties in Pennsylvania, South Jersey, and Newcastle County in Delaware. So here you see, show me a city that's growing in population. I'll generally show you a city where the housing market's pretty robust. The blue line here in this chart is the Philadelphia MSA, and the orange line is just Philadelphia City, the city of Philadelphia. You can see the big winner over the last 25 years is the Washington, D.C. metro area, which has grown quite sharply in population. Notice that even during when the housing bubble burst in the Great Recession, Philadelphia, as well as the Philadelphia metro area, lost population. The DC area continued to grow in population. And even during COVID, let me minimize something here. Even during COVID, over here on the right, you can see that while we lost population in both the city and both the suburbs actually gained population during COVID. That's the blue line right here, because of people fleeing the city. Philadelphia lost population. That's the orange line here. And we are still below our peak level of the pre-COVID level of 2020. So we had a lot of people, we had people flee the city. In terms of the number of people we lost, it wasn't huge, but it was the one segment of the population that you can least afford to use, which is very wealthy retirees. These are center city condo owners who are empty nesters or boomers, both. And due to the combination of COVID, the quarantining, the fact that they're more prone to catching a disease, as well as what many people seem to forget, the social unrest during the time. Many of them left they retired basically early. They went to their house down the shore, the condo in Arizona or Florida, figuring they would ride COVID out. And you know what? They just stayed there. They're in their 70s, 80s. They're not coming back. So even though our population loss was not large in terms of numbers or even percents, it's sort of like losing. If you have a large household, but you lose the major breadwinner, that's still going to have an impact, even though you only lost one person. Well, it's similar to that in public economics. So we are still fiscally struggling with that shrinkage in our tax base. Let me minimize that. Okay. So next slide. Let's look at job growth. Again, that's another one of the main drivers of the housing market. If you're growing in population, you're growing in jobs, chances are your housing market's doing robustly. Here we have the same lines for the same major 5 metro areas here in the Northeast corridor. Again, the orange line here is the city of Philadelphia. The blue line here is the Philadelphia metro area. It includes the suburbs. And then we have DC as the purple line. Baltimore is the yellowish line. And then New York over here is the gray line. The reason these lines are so volatile is because jobs are very, very seasonal. So, there's things like hiring, retail jobs grow in the winter. Agriculture jobs grow in the summertime and in the fall during harvesting. We have resumed our pre-COVID path of job growth. You see the big dip over here on the right. That's all the job losses that happened in 2020 to 21 during COVID. It hit everyone roughly about the same. We have roughly returned to our pre-COVID path, so we've rebounded from our bottom. And if you just extrapolate here, Matt, you can see my cursor, right? I hope.
Yes.
Yep, you can. Good.
Yes. Yep.
Yeah. If you extrapolate from where we were pre-COVID and just sort of, drew that trend line out, you can see we're roughly back to where we are to our pre-COVID levels. And that's generally true of most cities. So the COVID blip has largely been capitalized and dissipated, and almost all metro areas are back to their long-term growth path. Unemployment. This is also a major leading indicator of recessions. The Fed watches this very closely. I'll give you some more on that later. Basically, the lower this is, not the economy may be doing well, but it's also inflationary. Generally speaking, an unemployment rate below 2% tends to be an inflation trigger. You might wonder, why is it not 0%? That is, everyone is working. That would cause inflation. Why is it 2% unemployment cause inflation? Because there's always some people in the economy that are voluntarily unemployed. They're going back to school. They're dealing with, or they had to deal with an illness. They're taking time off to write the great American novel, choose something. But historically speaking, 2% tends to be the trigger rate for inflation. This chart goes back to 1990. Again, you can see the huge spike in unemployment. That's during COVID. Again, we've largely washed that out. We're back to our long-term path. Right now, the unemployment in Philadelphia is a little over 4%, so no danger of inflation due to tight labor markets here in the city. In the suburbs, it's down to around 3%. But you can see a lot of the major metro areas are starting to flirt with that 2% line, which, by the way, would trigger further rate increases by the Fed, which I'm sure nobody here on this presentation would view as welcome news. Speaking of interest rates, they remain above their COVID level lows. I'm sure you know this. This is the 30-year fixed going back to 2015. The gray area here is the COVID recession of 2020. As you know, the years from 2020 to 2022 were pretty good. Interest rates, the long-term rate, 30-year fixed, was around 3%. Since then, it's grown sharply. It almost hit 8% in 2024, and right now it's been sort of bouncing around between 6 and 7%. So that's been pretty persistent. Right now, high interest rates are not only what I hear most realtors complaining about in terms of what might be hindering their practice, but it's also what most home builders are complaining about too. Basically, the builders are saying that their capital stack is frozen up. If you don't have any projects that are out of the ground right now, chances are you can't get financing for anything unless you can show that it's already 90% leased, or you've got a guaranteed buyer, you're building to suit or something like that. So right now, the building industry, the development industry, and all the home builders are sort of in a holding pattern, and that they're trying to lease up the projects that are finished. They're trying to finish the projects that are out of the ground. But other than that, they're not starting anything new because you can't get financing for it, not from the banks, and also not from private equity, unless it's a truly exceptional project. So I talked about unemployment and interest rates earlier. So let me tell you how you can forecast interest rates. So when your clients ask you, when do you think the 30-year fix might be more favorable for me to make a move? Here's what you can tell them. So here's the 30-year fix. That's the solid blue line. The University of Michigan takes a survey every month of inflationary expectations. They ask consumers and businesses, over the next 12 months, how much do you expect prices to rise for you? Okay. So 2% here tends to be the trigger threshold for the Federal Reserve. And for those of you that don't know, I used to work for the Federal Reserve. It was my first job after college. I actually worked in Washington for the Board of Governors. So I know a little something about how the Fed thinks. And I can tell you that one of the leading indicators they watch are this inflation expectations. So notice that when inflation expectations are above 2%, it may not be by much, that's the dotted line, interest rates generally remain stable, okay? When it falls below that, which is what it did during COVID, then inflation expectations were low because we had a recession, but then they rose above 2%. Okay. And when interest rates rise, when inflation expectations rise above that threshold, what does the Federal Reserve do? Raises rates. Okay. So an inflation rate of 3%, expected inflation rate of 3% may not sound like much compared to 2%. But remember, you have to take compounding into account. If you put $1 in the bank, for 20 years and another dollar at 2%, another dollar in the bank at 3%, and you wait long enough, the dollar that you put in that's earning 3% will pay off substantially more than the dollar that's only earning 2%. And the Fed knows that, believe me. So they are watching is one of their leading indicators of inflation, which they are by law bound to fight. If that's significantly above 2%, that's when they start raising rates. So if you want to know when rates are coming down, when inflationary expectations start to drop back to 2%. And if they go negative, the Fed will actually really drop rates because that means we're in a recession. All right. So, but believe it or not, the silver lining of if Mr. Trump's tariffs cause a recession and the stock market to crash, the Fed will lower rates. So you will have an offsetting benefit to that cost, but I'll give a little more on that later. So anyway, next time your clients ask you about when interest rates are going to become more favorable, you can say with a great deal of confidence, well, the University of Michigan survey of expected inflation says that right now we're at an expected inflation rate of about 2 to 3%, and we need that to drop down to 2% or even a little bit lower before the Fed becomes comfortable to lower rates. So there you go. You can sound like an expert. All right, next slide. So let's look at income growth. I talked about population and jobs. Income is another major demand side driver of the housing market. So here I've got average hourly earnings going back to 2011 for our 5 major metro areas. Again, the orange line down here is Philadelphia County, and the blue line right here is the Philadelphia MSA. Compared to all our comparable metro areas here in the Northeast, we really took it on the chin in terms of income due to COVID. If you look, here's our peak right here in 2022. Most notice that COVID affected population and the number of jobs across the board in other cities, but it didn't really affect earnings across the cities. Only Philadelphia County, not even our suburbs, really took a hit. Average hourly earnings during COVID at their peak were about $35 an hour. And then notice how they fell to about $32 an hour a year ago. We've had a slight rebound since then, maybe call it 33 or $33 an hour now is the average earning in Philadelphia, but that's still below our pre-COVID peak, whereas the other cities have continued to trend up. So that's not great news for us, but it also means that we're not as overvalued or as overpriced as other metro areas are either. So another thing that drives the demand side of the market is just basically consumer sentiment. Housing is unique among assets, not just unique among real estate, but unique among all assets like stocks and bonds, and that emotion is involved in purchasing a home. That is whether you like the home. How does it make you feel? Especially if you're buying one that you'll be living in yourself. So you're not just making probably the biggest investment of your life, you're also making the biggest purchase of your life. A home is not only an investment vehicle, it's also a consumption good, just like a car or furniture is. So when consumers are feeling optimistic, they're more likely to commit money to a major investment like a home. This is consumer sentiment. It's scaled on a value of 0 to 100. Basically, the higher the index, the more optimistic consumers are feeling. You can see right before COVID, consumers were feeling great back in 2019 with the index at a value of 100. Then there was the immediate drop from COVID, and then it dropped even further when the recession hit. It fell down to a value of about 50 back in 2022. What that means is 50% back in 2022, 50% of consumers were relatively optimistic about the near future. 50% were pessimistic. We've had a slow rebound since then. You're wondering why the line is so volatile. Again, there's a lot of seasonality and noise in this survey. Right now, we're at a value of just above 60. So roughly 40% of consumers are pessimistic about their future than optimistic, and 60% are more optimistic than pessimistic. So glad that we're off our bottom from a few years ago, but we're near where our peak was prior to COVID. So consumers are still responding very cautiously to the hit that they took during COVID. All right, so let's compare consumer sentiment to home builder sentiment. So the orange line here is the same one as in the previous chart I showed you, but now I've added home builder sentiment. The National Association of Home Builders surveys their members every month, again, asking on a scale of 0 to 100, how optimistic or pessimistic are you? Value of the index over 50 means more home builders are optimistic than pessimistic, and vice versa if the index is below that. Home builders have had an opposite reaction to COVID than consumers. They're still on the relatively pessimistic side. You'll notice that when their sentiment dropped, home builder sentiment plunged by even more than consumer sentiment. It fell all the way back to nearly where it was back during the depths of the Great Recession when the housing bubble burst in 2009, when the home builder sentiment index had a value of 15, if you can believe it. When COVID hit, it dropped to 19. It has since rebounded, but again, not as much as consumer sentiment. And again, a large reason for that is because home builders right now are largely speaking in a holding pattern. They're finishing up the projects they have and then waiting for something to shift in the larger economy, like interest rates, to make things more favorable to set off the next cycle. But notice that they're not in a terribly pessimistic mood either. So right now the index has a value of around 50. So even with all the uncertainty going on in the market, they're not in full-blown panic mode like they were roughly 15 years ago or so when the Great Recession hit. So again, consumers, home builders, not super optimistic, but they're not in full-blown pessimistic or panic mode either. So that's good. So that's the demand side. Let's talk about the supply side of housing, the macro drivers of supply. So one of the biggest ones is construction costs. Excuse me while I take a sip of my coffee. So the government also publishes, in addition to the Consumer Price Index, which measures inflation, they publish indices on building costs and wages for employment and construction. So we'll start with wages. So the orange line here is the wage index for employment and construction. So just like the CPI, the actual level of the index doesn't mean anything, but its percent change over time reflects the percent change for wages for people who are employed in the construction industry. So historically speaking, as you can see, labor costs have historically tracked inflation. The orange line, by and large, moves along with the gray line, which is the consumer price index. But lately, if I add materials costs to that, you can see they have really, really spiked since COVID. So the blue line here is the index for construction materials. So it's a composite index that measures things like the cost of lumber, the cost of steel, the cost of sheetrock, cost of concrete, the cost of tile, basically everything that goes into building a building, including building homes. And as you can see, historically speaking, prior to COVID, materials costs tracked inflation, much like wage costs tracked inflation in the construction industry. But since COVID, materials costs have really spiked. And I'm guessing you all remember the supply chain choke points that happened during COVID. If you remember those images of all those huge cargo ships sitting off Long Beach in California, basically in a holding pattern because they couldn't dock in time. The dock workers couldn't go to work because of the quarantines, and that jammed up the supply chain. And as anyone will tell you in real estate development, almost all development is done with borrowed money. So having your supply chain locked up and delaying the completion of your project is equivalent to, not paying your credit card every month or only paying part of it. Interest starts to accumulate on you very fast. Time is money, as the saying goes. So a supply chain choke point, even if materials costs have not risen, will still cause your cost to rise if you're a builder or a developer. But in this case, we have materials costs rise not only due to the supply chain choke points, but also just due to the inflation of the Biden years that occurred. So wages held steady during the post-COVID years, but materials costs have grown significantly. As you can see, that is roughly a 40% spike, which is materials costs rose even higher than inflation. Okay, let me repeat that. Materials costs since COVID have risen even higher than what general inflation in the economy has been. I have to point this out to many members of our city council and their staff when they want to impose things like rent control, because materials costs are the biggest costs that an individual landlord faces, because that's what they use to maintain the property. You've got to paint the property, you've got to replace walls that are damaged with sheetrock, patch them up. You've got to replace some wood that gets damaged over time. Then every once in a while, you've got to remodel something because it's just dated. Well, when you go to Lowe's or Home Depot to buy that stuff, they're facing higher prices. So when the landlords are facing higher prices, they're either going to pass those costs on to renters, but if you have rent control, you can't do that. So that means the landlord either has to eat the costs, or if they can't eat the costs because their profit margins are so thin, which is typical of very small landlords, then their only option then is to under-maintain the property, or in the extreme case, abandon it altogether. So if you think the cost of sheetrock has nothing to do with the housing market, it does. It's just an indirect effect that most people don't realize. Driving materials costs up drives the incentive to maintain properties down, because landlords now face a higher cost of maintaining and even upgrading those properties. So as materials costs are high, you can expect more depreciation, physical depreciation in the housing stock of your region. And as the physical depreciation occurs, so too will the economic depreciation, meaning that the homes are worth less than they would be otherwise. That causes a shrinkage to your tax base, and that means you now have less revenue to fund your schools, police, fire, pave the roads, all that stuff. So the cost of sheetrock and the cost of lumber, the cost of spackling, even small cost of nails, even all that small stuff, definitely filters down through to its effect on the housing market. So high materials costs are not good for the quality and value of your housing stock. Let's look at some of the housing or the real estate indicators now. These are rents per square foot by sector in our region. On the left, I've got rents per square foot for the four major categories of property: industrial, apartment, office, and retail. And on the right, I've got it for the MSA. You can see, generally speaking, the city commands a higher rent per square foot because it's denser. Square foot in a 30-story office tower is going to be worth more than a square foot in an office park out in King of Prussia. And here you can see that. Let's look at apartments, since that's in the residential sector, and we've had such enormous uh, amounts of building in that sector. In the city right now, an apartment rents per year for about $18 a foot. In the suburbs, it's about $15 a foot. And again, you can see that differential again, because in the city you have more amenities that are walkable to you, as well as you typically have views in a center city apartment than you would in a mid-rise garden apartment in the suburbs. If we break it up across our MSAs, you can really see how Philadelphia stacks up to our counterparts here in the Northeast Mid-Atlantic. The big outlier, of course, is New York. That's in the middle right here. So an apartment in Philadelphia rents for $18 a foot. In New York, and this is the metro area, not just downtown. It's $26 a foot. I'm sure if I showed this to you for just Manhattan, it would be at least $50 a foot. But we're generally comparable to DC and Baltimore. At least our MSA is we're at somewhat of a discount to them. But again, what is also interesting about this is notice that office rents, which are the blue bars, are lower than retail rents and only slightly higher than apartment rents. Excuse me. The office rents are only slightly higher than apartment rents. The gap used to be much bigger. Now, the reason being is that we're still dealing with the whole shift to working from home. So office rents have actually come down, particularly in Class B and C space in the city. Office rents used to be around $35 a foot. Now they're around $28 a foot, and that's including Class A and trophy space. If I looked at just Class B or C space, rents would be comparable to apartment rents, around $15 a foot. So in the city right now, there's one of the major issues in the development community is how can we convert a lot of that older Class B and C space to another use, particularly residential, because that's the space that people don't want to come back to work in. Right now, most office landlords will tell you that amenitizing their very best space, A space, trophy space, and upgrading somewhat older space to add more amenities like kitchenettes, private bathrooms, secure bike racks downstairs, things like that. That's what office landlords are now using to draw people back to work. They're still trying to. We have not yet successfully gotten back to where we were pre-COVID. But that is how right now how the office sector is linked to the residential sector. That's rents. Let's look at prices. Here's the price of real estate. Again, notice now that the price of office space in the city is actually less than the price of residential space or apartment space. Office space right now in Center City is going for about $184 a foot if you wanted to buy an office building. If you buy an apartment in and around Center City, you're going to pay about $207 a foot. Again, that is overwhelmingly due to the shift to working from home. So the reason that this 184 a foot is there and it's less than 207 a foot is, again, this includes a lot of old B and C space that is currently vacant right now. So that's dragging the average down. But again, when it comes to how we stack up compared to our other comps here in the Mid-Atlantic, New York far and away the leader. Here's the Philadelphia metro area's price of real estate by category, and here's New York. So if you wanted to buy an apartment building in Philly, it's about $207 a foot. You want to buy an apartment in New York, and this is just the metro area, not just Manhattan. So this includes Long Island and places like that. You're going to pay $1,100 a foot. So nearly 10 times what you'd pay in Philadelphia. So you can really see how, despite what you read about New York and the rise in crime and homelessness and all that during COVID, it is still commanding a premium. Now, if I compared these New York bars to pre-COVID, again, the bars would probably be off the charts. So they've taken a hit, But New York is still New York and is still the leader of the pack when it comes to the price of real estate. So let's look at some quick comps in the apartment sector to see what's moving where. And then I'll get to single family housing. So these are the 10 most recent sales of apartment properties here in the tri-state area. Each dot represents a sale. And then over here, I've got the address and the price per unit. So the big winner, number 4 out here in Phoenixville. I'm sorry, the big winner out here is in Plymouth Meeting, number 7, right there. That's 349 Chilton Court. That went for about $363,000 a unit. In second place is here, this one in Phoenixville, number 4, which went for, there's number 4 right there, which went for $241,000 a unit. And then third, 221 Bryn Mawr Avenue, number 2, which is right there, so very close in on the main line there. And that building went for about $221,000 a unit. So that's the general price variation you can see across the region in terms of what apartments are going for. Offices, I did price per square foot. Here you can see the big winner here was 401 Parkway Drive, Broomall. That's number 3 right there. That went for $345 a foot. Here's one in Wayne, number 1 right there. That went for $286 a foot. And then you can see the others are generally going for hundreds of dollars per square foot. You probably may not be directly interested in the office market, but like I said, the office market right now is linked very closely to the housing market because of the shift in working from home. Basically, they're both competing for tenants, okay? They're both competing for the same tenants, office space and residential space. So let's move into the single family market. Rents have jumped substantially since COVID. This shows median monthly rent by county going back to 2010. And then the dashed line here is the rate of inflation. So you can see how rents have done relative to inflation. The blue lines are the Pennsylvania counties like Bucks, Montgomery, Delaware. The green lines are the South Jersey counties like Gloucester and Burlington, places like that. The red line is Philadelphia County, and the purple line here is Newcastle County in Delaware. So if you think of this as, first of all, notice the general pattern. They move in, roughly speaking, in tandem over time, even though there's a spread between them because some markets are more expensive than others, no surprise. But in general, prior to COVID, which is the dashed line, rents generally moved with inflation. Inflation's the dashed line right here. So if inflation goes up by 1.5% a year, rents typically go up by 1.5%. So rents generally used to track closely with inflation. Not since COVID. Everyone's gone up. You know inflation has gone up. You can see the dashed black line has increased its slope, or its rate of ascent has become more steep. But notice that the same is true for rents, and even by more so. Also, what I find particularly surprising about this is that some of the highest rents in the region are actually in the South Jersey counties. So Gloucester County here, Mercer County here, that doesn't surprise me because it has Princeton. But you see some of the blue counties down here. But notice that they're all higher than Philadelphia. Pre-COVID, Philadelphia was sort of in the middle of the pack, actually. I mean, some counties were actually cheaper, like what do we have here? So this would have been Camden County was cheaper, Burlington County was cheaper, and this light blue line here, this was Delaware County. But right now, again, due to the outflux or exodus, I should say, of wealthier households from the city, that has caused rents in Philadelphia to actually lag its suburban counterparts. So Philadelphia was roughly in the middle of the pack pre-COVID. Now notice that it's dead last. Median rent in Philly right now for a dwelling is about, call it close to $1,800 a month per unit. By contrast, out in, say, Princeton, you're looking at paying $2,500 per unit. So quite a difference. So again, even though I know many housing advocates in the city and advocates for rent control saying, yeah, well, rents are up since COVID, but incomes are not up. I answer yes. But rents in Philly are still up by less than they are in our suburban counterparts and even in many other cities. Like I said, I have median rent by county right now in 2025. Philadelphia's right here at $1,700, the lowest of any county in the region. Mercer's out here at $2,500 per month in that county. So again, by our own historical standard, if you're only looking at Philly, which I think is a very myopic way to look at the market, yeah, well, rents are up in Philly. They're not up by as much as inflation. They're not housing, building materials costs are up by even more than rents, which means profit margins to being a landlord have become tighter in Philly. And also, we're not as up as much by our suburban counterparts. So context is very much, I wouldn't say everything, but very, very important when you are looking at housing indicators for just Philadelphia. When you start comparing us to other cities, when you start comparing us to the other drivers of housing, rents and prices have increased. They've increased, are up by more than they are historically, but they're often not as up by much as we think compared to our counterparts, and they're also not nearly up by much as the supply side cost of housing. That is the cost of materials, and even the cost of land is up by even more. All right, so speaking of price, that's rents. Let's look at house prices. We know that house prices have risen dramatically, both locally and nationally. So here's the actual numbers. The red line is my house price index for Philadelphia County. The green line is my house price index for just the Philadelphia suburbs, all the collar counties. And then for context, I've got the national house price index from Case-Shiller. So the indices reflect the general movements in house prices after removing all the noise that's in housing data. So whether large homes sold in 1 month versus small homes the next, and the seasonal effect that, house prices always go up in the warm weather months when you transition from winter and then cool off again when you go back to the cold weather months. I've controlled for all that. So think of this as a Dow Jones index for the typical Philadelphia home. So yeah, here's the housing bubble right here. Peak to trough, house prices in Philly and the suburbs fell by roughly 23% in both, peak to trough, okay? We've been going up ever since we hit bottom in 2012, and we've had some pretty aggressive appreciation throughout the teens. And then COVID hit, and look at the rise since COVID, up 60% in just 4 years, all right? So that works out to roughly about 15% per year, 15% rate of return. For context, the stock market gives about 7 to 8% return per year. Right? You put $1 in the stock market, typically you'll get $1.07 or $1.08 back at the end of the year. I'm obviously not counting for taxes or debt or anything like that, just cash. So if you just bought a random Philadelphia home pre-COVID in 2020, early 2020, and just sat on it, you could expect it to be up by 15% per year, or a total of 60% in 4 years. That's a very, very aggressive rate of appreciation. So when housing advocates say, yeah, house prices are up, rents are up, I say, yes, that's true. That's absolutely true. Well, we've had very aggressive growth over the last several years. You can see a little dip at the very end there, and that's because we're largely leveling off. I view that as a good thing. Why have they risen so dramatically? We've got three drivers of house prices since COVID. We've had low interest rates. Interest rates are basically the price of credit, or even more bluntly, as I tell my students, they're the price of money, right? When money's cheap because interest rates are low, guess what? The prices of things go up. That's inflation. We've also had very low inventories, as I'm sure most of you know. That's the supply of homes listed for sale. When supply is tight, but demand is strong because interest rates are low, what happens? Prices of things go up. And then we've also had an additional demand side driver, and of course, that's just the shift to working from home. So when you add increases in demand, decreases in supply, and cheap money to the mix, what do you get? That's a recipe for very aggressive price growth, and that's exactly what we've gotten. And that has to change because that rate of growth not only is unsustainable, it's also undesirable. If we break it out by county, we can see that the same is generally true across the board, no matter where we are. Again, the red line is Philadelphia County. Here, unlike rents, we actually sort of beat the market in terms of prices. So, by the way, ignore this says Q3. That should be Q4. Like I said, I had to put this together very, very fast for you guys with the latest data, and the quarter just rolled over a little over a week ago when I got my new data. So again, notice that since COVID, in fact, just since the housing bubble, we were in the middle of the pack when the housing bubble finally stabilized and the recovery began right here. There's my cursor. But notice that we've beat our suburban counterparts, most of our suburban counterparts, in terms of price growth. So the red line here is the same as the red line here on this chart. I just added the suburban counties. The ones that have sort of lose the horse race, if you will, if you think of this as running a race between price growth, between counties, house price growth, is the South Jersey counties. And that's because they're especially challenged in terms of their fundamentals. It's a very expensive market to build in. Property taxes, as you know, in Jersey are the highest in the country. And the other fundamentals for South Jersey in general are not great. That is population growth, job growth. They tend to lag the rest of the state and the rest of the region. So no surprise that the Jersey housing market, South Jersey comes in last. Philadelphia does very well. Again, that's largely due to the fact that we still, despite COVID, have had a lot of revitalization of many of the neighborhoods that are peripheral to Center City, primarily young people, as you know, moving in. They're getting older. Millennials are pairing up. They're marrying. They're having kids. That typically necessitates a change in housing. A lot of them have now paid off their student debt because they're more than 10 years out of school, and they're getting older, so their salaries are rising. And so you can see house prices in the city have done quite well since COVID in the past few years. The big winners, though, Again, they're very wealthy counties, particularly Chester, Bucks, and Mercer counties are the big winners. And here you can see the spread in prices. Top of the list is Chester County, median house price of 435,000, Philadelphia, median house price of 250,000. So again, quite a difference compared to our suburban counterparts. Of course, you all want to know where the home sales are and what they're going for. So this is home sales in the most recent in 2024 Q4. I didn't have time to do the map yet for Q1, but it won't look any different. I use cool colors to denote relatively low price sales, warm colors to denote relatively high price sales. So you can see the lowest priced markets here, North Philly, these are the blue dots, North Philly, West Philly, the inner ring blue collar suburbs of Yardley, Eden, places like that. South Jersey, very tough. It's almost all blue. You've got this pocket of red, which is sort of the trinity of Collingswood and Cherry Hill. What's the other one I'm blanking on?
Haddonfield.
Yeah, Haddonfield. That's it. Thank you. Mount Holly, right here, which is kind of a historic community. Up here, you've got Trenton, very low priced, and then up here you've got Princeton, which is probably the highest price homes in the region. By the way, notice that just by crossing City Avenue, you go from some of the cheapest homes in the region to some of the most expensive homes. So just by crossing the street. So if you want to know what the value of the Lower Merion School District is and Lower Merion Public Safety and other Lower Merion Public Services, that's your answer right there. That's the premium voters are willing to pay. You move from homes that are $110 a foot to homes that are over $210 a foot. That's more than a doubling in the average price just by crossing the street. That's prices. Let's look at sales. The sales, as we know, right now are relatively in sort of a holding pattern. They're near their historic average. Much like prices, sales tend to be very cyclical. Our quarterly average is this red line right here. In any given quarter, about 18,000 homes change hands across the region. You see the dip here during the Great Recession. Here's the rebound. You can see right when after COVID hit, the peak years when conditions were ideal to be selling a home because people were working from home. Interest rates were low, and supply was low, so they were paying top dollar. Home sales activity back in 2021 was probably around the same peak as they were during the peak of the housing bubble. Over 25,000 homes were changing hands per quarter. It's been trending down since. But again, notice that we're still near our historic average. So the trend may be down, but it's not terrible. We're not near the depths like we were during the Great Recession. Of course, we all know why. For right now, for first-time home buyers, affordability is their main challenge. They may have the income, they may have the credit score, they may have reduced their debt, but coming up with that down payment, since house price growth has been growing at galloping rates and income growth has not kept up, they just don't have the amount of savings they need. And of course, I've heard from a lot of realtors, I would guess some of you could verify this, that right now they are seeing more cash assistance from parents to their kids right now at closing than they've ever seen before. In particular, parents are giving their middle-aged kids are approaching middle age. They're in their 30s now. They're first-time home buyers saying, you don't have to wait till I pass on for your inheritance. Here it is now. Buy a home. And by the way, start producing some grandkids for your mom and me. Okay. So that's the challenge to first-time home buyers is affordability, particularly that down payment. For move-up buyers, the problem is what we call the lock-in effect, which I'm sure you probably know of and have seen as well. And that's the effect of higher interest rates. So if you bought a home, say 10 years ago, and you're ready to be a move-up buyer now, or even just 5 years ago, inventories are low, so your selection that's out there available is low. So that means typically you're not going to get your dream home. You're going to have to settle for the third or fourth best home that you wanted. But on top of that, interest rates are higher. So you'll be swapping a mortgage payment for the house that you already have for a higher mortgage payment for a house that is not your dream home anyway because inventories are so low. So for a lot of people, that's asking, you're basically asking them, well, would you trade, the Bentley that you have for an even higher priced Hyundai? Would you take that deal? Most people won't. And that's the challenge that the move-up buyers are facing, that lock-in effect. So they're locked into their homes until either inventories rise and they get comfortable with paying top dollar, but it's for their dream home, or interest rates fall so that their new mortgage payment is in line with their current one or only modestly larger than the current one. Or even if you're downsizing because you're an empty nester, you could still end up with a larger mortgage payment due to higher prices and higher rates. So that's what's sort of jamming up the market right now, at least what I'm seeing on paper. So we all want to know where the money is hitting. These are the $1 million sales. The thing I find interesting about this is that they're becoming less spatially concentrated across both the city and the region. So prior to COVID, this is a map of all $1 million home sales in the fourth quarter of 2024. So if I showed you this map prior to COVID, you would only see $1 million sales basically around Rittenhouse Square and around Washington Square. And by the way, these are single family homes only. These are not including condos. There would be even more then. And every once in a while, twice a year, you'd see some $1 million sales up in Chestnut Hill. But notice that they're spreading out, okay? You see them now in Queen Village. Now you're getting them several blocks from Rittenhouse Square. You're getting them in University City, north of Vine Street. You're getting them in Fairmount, places like that. Even Northern Liberties in Fishtown. Not many, but this is very new to have $1 million sale in Northern Liberties or Fishtown. I mean, even a $500,000 sale was unthinkable in these neighborhoods 20 years ago. But now we're actually starting to see the occasional $1 million sale, and I expect to see more. And we're still seeing them up in the Northwest as too. Now we're starting to see $2 million sales up in Chestnut Hill. Prior to COVID, a $2 million home was basically an estate. Now it's what used to be a $1 million home up there. And if we go to the region, you can really see where the money is landing. So here's $1 million home sales across the region in Q4. Again, you can see them, the same ones here in Center City. But again, notice just by crossing City Avenue, you go from no $1 million sales to plenty of them. Of course, this is the main line right there. Then you get to the outer suburbs. A lot of these are like horse farms, estates. Very, very few $1 million sales in South Jersey. Again, Cherry Hill, Haddonfield, Collingswood area, Mount Laurel, I believe, right there. And then, of course, you have these in Bucks County. A lot of these are expatriate New Yorkers that have moved there. They've got a very short drive to the train station at Trenton. And from there, you're in Penn Station in New York in about 45 minutes. That's actually Staten Island right there. That's how close it is. And then you've got Princeton. You've got Princeton money, and you've also got New York money, again, because they're so close. What would actually be a $1 million home on the main line is probably a $2.5 million home in Princeton, just because it is actually the highest price market in our region, not the main line, believe it or not. There's more $1 million homes on the main line, but the greatest concentration of highest price homes are actually up in Princeton. All right, so that's where the market is at. So where are we going? So one of the questions I get asked all the time is, are we in another bubble? Are we in another housing bubble? So let me give you my speech on that. My short answer is no, and I'm going to try to, but not just because I say it, so I'm going to try to convince you of that. First of all, I want to make sure that we understand what a bubble is, because it's one of the most overused terms in finance and economics. People have come to use the term bubble just to mean that we're due for a downturn. A bubble is a very specific kind of downturn. The very definition of a bubble means that current prices cannot be rationalized by their fundamentals. All right, prices are too high to be explained by what drives prices. So, in stocks, it means prices are high relative to earnings. Companies aren't earning enough to justify such high prices. In bonds, it means that prices are too high relative to interest rates. Low interest rates are not enough to explain high bond prices. In real estate, when prices are high, it means you can't explain them by the things that drive house prices. So interest rates, rents, jobs, population, building materials costs, building wage costs, land prices, all the things that drive house prices. Prices are too high to be explained by the prices of those things that drive them. My short answer is we are not in a bubble and that prices are not out of line with fundamentals, but that doesn't mean we're not due for a correction. You can still have a downturn, but it's due to deteriorating fundamentals. So I expect that insofar as we're going to have a downturn, it will be the direction of causation will be the reverse of what happened during the bubble bursting, when the housing bubble burst. When the housing bubble burst, the decline in housing drove a national recession. This time the causation will be the opposite, and also which is more typical, meaning a national recession will take housing with it. It will drive a housing downturn. But I don't think we're in a bubble. So first of all, let me try to convince you of that. So let's look at current mortgage debt today. So this has the current mortgage delinquency rate going back to 2001, okay? And it's broken out in color by the degree to which current outstanding mortgage loans are delinquent. So the red lines are the ones that are only mildly delinquent, 30 days, 60 days or so. Gray is the amount of the percent of mortgages that are 120 plus days late, and blue is the percent of mortgages that are severely derogatory, okay? The black line is the historic average. So in any given quarter, about 5% of all U.S. mortgages are delinquent to some extent or another. First of all, notice we're way below our historic average. Right now, only about a call it 4% of all outstanding mortgages are delinquent. All right. So first of all, we're well below our historic average. Second of all, look at the composition of the color of the bars. So during the housing recession, notice that the most of delinquencies were either a huge percent of loans were either 120 plus day late or severely derogatory, severely delinquent. Okay. So when people started to go delinquent, they went delinquent for a long time. Notice right now that not only are mortgage loans, generally speaking, a very small percent are delinquent, but those that are delinquent are only delinquent by a little bit. These are the red and pink bars. They're only 30 to 60 days. So the red and pink here are a much smaller composition of total delinquencies than they were over here, right? You had severe delinquencies, not only a high rate of delinquency, but many severe delinquencies when the housing bubble started to collapse. So right now, we're not only running below average, but very, very few mortgages of those that are delinquent are seriously delinquent. And the same, by the way, is also true of foreclosures, which are also currently below their historic average. Delinquencies and foreclosures tend to be leading indicators of the housing market. When you see delinquencies go up, you can start to expect to see foreclosures grow up. And when foreclosures go up, that often starts to bring prices down because you're adding a lot of very, very low priced homes to the market. And they often tend to be in substandard condition too. As most of you are sure, I'm sure you're aware, having the house next door to a house that you're listing go into foreclosure and become abandoned and boarded up is not good for the value of the property you're trying to list. And the same is true in aggregate of the housing market. So delinquency rates down, main point, okay? Unlike during the housing bubble. Second reason I don't think we're in a bubble. This shows recent borrowers right now are much more creditworthy than they were during the bubble years. So this breaks out total mortgages by their credit score, okay? So blue and gray in this case is good. Those are people with credit scores of more than 720. Blue is more than 760, okay? So notice that during the bubble years of 03, 04, 05, notice that pink and gray were a big percent of all outstanding mortgages. These were people with low credit scores. So for example, dark red, these are people who got mortgages with a credit score of less than 620. Notice that they may have been only 10 to 15% of all mortgages during the bubble, but they're near zero now, okay? I'm sure you heard the old joke, you know, back during the bubble years, for those of you that are old enough to have been active at the time, and you're still young, by the way, but if you're experienced. You know that the saying was, you know, if you could fog up a mirror with your breath or have a pulse, you could get a mortgage. You know, it was common for those of you who are younger, during the housing bubble years, it was actually quite common for realtors to do showings for buyers that were not even pre-qualified because you didn't have to. You knew the lenders were happy to give you a loan regardless of your personal financial circumstances because house prices were going up. So if you fell delinquent, they would just take the house back and the house was now worth more than when they originally lent money on you to buy it. So they didn't care. That's not the case now. Lenders really learned their lesson from those years, and it stuck with them. So today's borrowers, notice, I mean, just look, I mean, 2/3 of all borrowers right now have credit scores of greater than 760. I mean, 760 is an outstanding score. And then the second tier, the gray bars, have scores between 720 and 759. These constitute what, 80 to 90% of all outstanding mortgages, right? So you see, there was a huge surge in mortgage lending during COVID. This is 2021, 2022. That has since slackened, right, as the markets become tighter and affordability has become more of an issue and interest rates have risen. But still, for all outstanding mortgages, the vast majority of borrowers are very, very creditworthy, okay? Very, very creditworthy, unlike during the bubble years of the 2000s. Third, current homeowners have a very low exposure to falling house prices. So during the bubble years, homeowners were very highly leveraged, meaning they owed a great deal of money on their properties relative to what their properties were worth. Now that's important because that measures how much at risk you are to falling prices. If you owe 100% on the home that you bought, so the home's worth say $300,000 and you have a $300,000 mortgage, just a slight downturn in the value of your home puts you underwater because you now owe more money on the house than the house is worth. So when house prices decline, people who are highly leveraged are the first ones that get hit. And they know that. They're not completely stupid. So what do you do if the house is now worth less than what the debt is on it that you owe? Well, basically, you can just default on it and sell it back to the bank for the outstanding balance of your mortgage. You know, put the keys in an envelope, send it to the bank, and just walk away. Now, obviously, your credit rating is going to take a massive hit, but that might be better than losing hundreds of thousands of dollars in money paying a mortgage for a home that's plummeting in value. So here we're going to look at loan to value, the loan to value ratio for U.S. mortgage. This measures how leveraged homeowners are. So it's just the ratio of the total amount of outstanding mortgage loans to the total value of the homes that they're borrowing against. So back during the housing bubble years, I was able to get this back to 2013, which is right after the market hit its low. 70%, excuse me, at that time, 70%, the average LTV was 70%. So home prices would have had to drop 30% before it put more homeowners underwater. Okay, so the higher the value of this index, the more leveraged buyers are. Right now, most home buyers only are leveraged at about less than 50% of the value of their home, meaning house prices would have to drop 50% before they would go underwater on their homes. All right, so the bottom line of this chart is that current homeowners have a much, much, much bigger cushion during the current market than they did during the previous one. They have much less exposure to a housing downturn. We would need catastrophic drops in house prices before current homeowners really started defaulting at the same rates they did during the housing bubble. Now, it doesn't mean it can't happen. I'm just saying that they have much more cushion this time against falling house prices, okay? And then lastly, the number of banks so far look very stable, even with the tightening market. So the FDIC keeps a list of problem banks. These are banks which are not sufficiently capitalized against a downturn. Notice the huge surge in problem banks during the housing bubble downturn. You had 900 banks on the list, okay, back during the depths of the Great Recession in 2010, 2011. And then the market hit bottom in 2012, and that started to come down. Right now, only about 1.5% of all banks are on the government's problem list, and that's well within the historically normal range of 1.2%. Again, because banks are not lending as freely as they did before, so they're also better capitalized right now. Not only are home buyers and borrowers have a bigger cushion against a housing downturn, but banks also have a bigger cushion. They've got more credit-worthy borrowers. They've got borrowers that are less leveraged, and banks are holding more capital against the potential of a downturn. So we have a much, much bigger cushion right now in the housing sector against a downturn. Again, that doesn't mean a downturn can't happen, but if insofar as a downturn does, it won't be because prices drop because homes are overvalued. Prices will drop because the economy goes south, and they just take house prices with it. That's the bottom line here. So let's look at some of the other leading indicators of the market and figure out where we're going. So we know that inventories are still near all-time lows. This shows the number of homes listed for sale in Philadelphia going back to 2003. I like to watch listings because they tend to be a leading indicator of the market. Notice that listings start to swell back in 2005, okay? Well before house prices started to drop. So inventory started to swell, supply started to go up. Econ 101, what happens to the price of something when supply goes up? Prices tend to go down. Inventories hit their peak in 2007, and that's when prices started to drop. 2007 was our peak in terms of prices. You'll notice all these little dips in inventories. That's seasonal. So, right, people delist their homes in the cold weather months, then relist them in the warm weather months. We hit bottom in 2022 when supply was super tight. Again, that's one of the reasons we saw such dramatic increases in house prices was supply was so tight. Supply has been rising. But we're still well below our historic average of roughly around 5,000 to 6,000 homes. But again, as you can see, inventories tend to move very, very slowly. So we're trending in the right direction, getting back toward a bit more balanced market, but we're not quite there. If we look at month supply of inventory, we still remain a seller's market, but they're starting again to tick up in the right direction. You may remember on the exam for your realtor's license, month supply of inventory tends to measure how balanced the market is. So you want something between 5 and 7 months, so right between here and here. That typically indicates a balanced market in which both buyers and sellers are roughly in equilibrium with each other. Neither one has any leverage over the other. So when inventory month supply is very high, that's a seller's market, a buyer's market, because supply is so high relative to demand. During the depths of the Great Recession, month supply of inventory rose to 13 months. We had a 13-month supply of homes listed for sale. 2022, we hit bottom. We had about a 1-month supply of homes for sale. That's quite a decline. And again, much like inventories in general, that's starting to trend up. We're at a 2-month supply right now. We're not where we need to be back in a balanced market. We need to be up here. Where's my cursor? We need to be roughly around here, 5 to 7 months. But you can see it's going to take a while to get there. So inventories are trending in the right direction, but again, they're moving slow. But I view that as a positive indicator because restoring balance to the market would be a good thing. We wouldn't have ridiculously galloping house prices. We'd have improved affordability. But most importantly, we'd have more transactions because there'd be more homes to choose from, and that's going to put some moderate downward pressure on prices and make them more affordable. I'll skip commercial real estate stuff here. So where are we going? What's the forecast? So this is the forecast for Philadelphia office space. Why should you care about this? Because if this forecast were bullish, that would imply that office owners were bullish and they're expecting a lot of people to come back to the office. Clearly, they are now. This forecast is generated by a consulting company called Green Street. The green line here is their commercial property index for Philadelphia. It's primarily office space. Here you can see the big dip during COVID when they started vacating offices and working from home, right? So the index dropped because the value of office space dropped. Where do they expect the value of office space to go? The green, they run different scenarios. The dashed green line is their baseline scenario, okay? They're projecting office prices in our region to rise by 0.75% per year. So they're not expecting office prices to drop any further, all right? So that's good. They've stabilized. But insofar as they're going to increase, they're going to increase at a rate that's below inflation. Even their most optimistic scenario says that by 2030, we still won't be back to where we were prior COVID. So generally speaking, the market and a lot of market analysts remain very bearish on office space, particularly in our region. Now, the next few years are going to be very interesting when it comes to office space because Philadelphia is going to see the highest number of expiring leases between now and 2030. So that's going to force a lot of companies to make long-term decisions about the location of the space they occupy and the size, okay? So until now, firms who are office tenants have been trying to woo workers back to work, and that's had mixed results. If you're in Class A or tenants, trophy space, you've done reasonably well. If you're in B or C space, you haven't been as fortunate. So what a lot of those tenants are going to be doing if they can't pull people back into their space is they're going to downsize. They're not going to downsize the size of the space they're occupying. They're going to also perhaps downsize their location. So they're going to move from a premier center city location to a suburban location, like, King of Prussia is my favorite place to look to. But there's other clusters, primarily along the main line, as well as a few in South Jersey as well. So that means office jobs are going to leave the city if they haven't already. Even though people may be working from home, they're still paying the wage. Many of them are still paying the wage tax if their office address is still technically in the city. So that could affect our tax base because it's going and by turn affect the city's revenues. Okay, so insofar as companies will downsize and also move to the suburbs, that could be good for the suburban market because you'll now have more people that are really committed to living in the suburbs because they're now working in the suburbs as well. Their employers have committed to a suburban location. So that could make them more bullish or more comfortable about buying a home in the suburbs rather than in the city. So good news for the suburbs, not so great for the city. But this is something that a lot of us will be watching very, very closely because, again, even if you're not a commercial broker, the overlap between the commercial market, particularly the office market and the residential market, has become very strong in the post-COVID period due to people working from home. So that's offices. Let's look at apartments. Here, the market's much more bullish. Again, people are spending more time at home, and that includes apartments. And as you well know, due to affordability issues, a lot of younger households that would otherwise be first-time home buyers are continuing to rent because they can't afford a home or they just don't feel comfortable given the uncertainty in the economy with committing to a home. So you can see during COVID, apartment prices did drop, much like office properties did. We've had a lot of new supply come online, so that's helped keep a lid on rents. But the market for apartments is still bullish, at least relative to the market for office space. So here's the baseline scenario. They're projecting the value of apartments to increase by 8.5% per year. Remember, single-family housing in Philly tends to grow by about 4.5% per year. So they're expecting apartment space to grow at a rate, the value of apartment space to grow at a rate roughly double that of single-family housing, which is pretty bullish. Pretty bullish. I might be a little more bullish than me because we've still got a lot of units coming online, particularly in the city along Spring Garden, Delaware Avenue. But I still agree with it. I'm relatively more bullish on apartment space, on the multifamily space, than I am on the single family space in the near term. By the near term, I mean 1 to 2 years. So let's talk about tariffs. All right. It's been a fun week. We know there's been a significant downturn in the market. We had a rebound yesterday, but there could be further downturns ahead. So let's look at what the stock market changes in the stock market mean for changes in the housing market. All right. So this is a chart of house prices and stock prices going all the way back to 1890. This comes from Bob Shiller. You may know the Case-Shiller house price indices. They're the ones that publish it. Bob Shiller also has a Nobel Prize for economics under his belt. And his big claim to fame, besides his excellent academic work, he's a professor at Yale, is that he was the first one to predict we were in a housing bubble way back in 2003. He looked at prices, he looked at fundamentals, and he said, this is unsustainable. And he proved it, and he was right. And he's been very, very much in demand ever since. So when he has a comment about the housing market, people pay attention. So he created this historic index for the typical American home. That's the blue line. That's the house price index for the typical American home going all the way back to 1890. How he constructed this, he had his research assistants gather a lot of very old data very thoroughly, but he constructed it. Now, both indices are what we call real, that is opposed to nominal. That means they're net of inflation. So the blue line shows, think of it as a Dow Jones index for the typical US home, shows the value of the home over time since 1890 adjusted for inflation, net of inflation. So when the index goes up, that means house prices were going up in the United States faster than inflation. All right. And this is the S&P 500. That's the orange line. Again, going back to 1890. Okay. And again, this is net of inflation. So when the orange line's going up, that means stock prices, the stock market was going up higher at a higher rate than inflation. See this little bump right here? That's the crash of 1929. That was the Great Depression right there. All right. Here you can see the inflation of the 70s. It did not, stock prices basically went up with inflation, so they didn't beat the market. Here is the tech bubble, right here, of the late 90s. Here is the housing bubble, right there. You can see the stock prices crashed in from roughly 07 to 09. They hit bottom. Here's the recovery. Here's the COVID crash, right there in 2020. And then here's the rebound. And you can't quite see it, but here's the crash of the last week, right there. That dip in the orange line. We had the biggest downward correction since COVID in the last week. Okay, and then, by the way, the COVID crash actually took like a few months. We accomplished that in 1 week. So what's the correlation between the stock market and the housing market? Or more specifically, the correlation between stock prices and house prices. The correlation coefficient between these two lines is 0.88. What that means is every 1 point rise in the stock market is associated with a 0.88 increase in house prices. All right. So a value of 1, a correlation coefficient of 1, means they move in complete tandem with each other. The stock market goes up by 1%, house prices go up by 1%. The stock market goes down by 1%, house prices go down by 1%. So house prices are definitely correlated with the stock market, but not perfectly so. In fact, they're relatively what we call inelastic. So if the stock market changes by 1%, we change by less than 1%, only 0.88%. Okay, but it's pretty close. The correlation is there. So what can history tell us? All right, like I said, this chart compares the real S&P 500, the orange line, to the real U.S. house price index, going all the way back to 1890. So we're going to let history see if it can guide us here. It's got a correlation coefficient of 0.88. Like I said, that means every 1 point movement in the stock markets associated with a 0.88 movement in house prices. All right. So let's go back to the Great Recession. So here I've cut the chart off at the year 2000. So again, the orange line is the S&P 500 since 2000. The blue line is the national U.S. house price index since 2000. So let's look at the housing bubble years in the Great Recession. All right. The stock market from peak to trough fell by 51% during the Great Recession. 51% decline in the S&P 500. House prices fell by 36%. So like I said, the correlation coefficient is less than 1, meaning house price changes tend to be lower than stock market changes. So house price changes are correlated with stock price changes, but not as much. Okay. Remember, stock prices move by 1%. House prices only move by 0.88%. Okay. And again, history bears this out during the last severe downturn. The stock prices fell by 51%. House prices fell by 36% nationally. Remember, locally, we only fell by 23%. We tend to be a relatively inelastic market, even compared to other U.S. housing markets. So when house prices are really up, our correlation coefficient is less than 1, is another way to put it. Meaning that when house prices are up in the country, we tend to be up by less. But when house prices are down, we tend to fall by less. Or as I like to say, you've probably heard me say it, Philadelphia doesn't party as hard during the good times, but we don't have as bad a hangover during the bad times. Okay. So stock prices fell 51% during the Great Recession. 36% is what house prices fell. What does that mean today? All right. So right now, over the last week, the stock market is down 19% from its pre-tariff peak, right? Biggest decline since COVID. So, based upon past historical data and correlations, that implies we can expect house prices to drop 16.5%. Now, I'm not taking into account the rebound that happened yesterday. So I'm, just sort of assuming that these tariffs would be around, for a while, okay? So remember, during our last downturn, house prices fell by 23%. This downturn, again, it would be a significant downturn, but would not be as bad as the housing bubble, at least if history is any guide so far, all right? So given what the stock market has done during the last week, how will that eventually filter through to house prices? Remember, the housing market moves much slower than the stock market, so it takes a while. Peak to trough, we can expect a 16.5% decline. I'm not saying that will happen. I'm just saying if the stock market decline persists and it takes another correction and it sort of stays down before it rebounds, that's sort of our worst case scenario of what we could expect just based upon stock prices, okay? But we also know that tariffs are going to affect other things, namely construction materials. We import a lot of our materials that go into home building, all right? Our labor may be local, may be mostly Americans. And by the way, the deportation issue also comes into play, but not so much here in the Northeast, more in the Sun Belt states where much of the construction labor market is populated by undocumented, but not as much here. So I'm going to ignore that. I'm going to focus on construction materials because they are hit by tariffs. So here I've got the price and the import prices of various construction materials that are used in home building. So on the upper left, I've got the import price of lumber. On the upper right, I've got the import price of steel and iron. On the lower left, I've got the import prices of stone, plaster, cement, asbestos, and other similar materials like ceramic products, glass, and glassware. And then on the lower right, I've got the import price index of all finished building materials. So these are going to be things like doorknobs and faucets and stuff like that. So these charts go back to 1996. The gray areas are the recessions. So here you see the bursting of the tech bubble recession of the early 2000s. Here's the Great Recession. Here's the COVID recession, which was severe but very brief. Okay, so look at the trends in imported building materials since COVID. Lumber is up, some volatility, but it's up. Over here, iron and steel, definitely up. Plaster, cement, asbestos, that was primarily driven up during the Great Recession, but it still remains very high and has risen since COVID. Finished building materials, again, your faucets, your doorknobs, way up since COVID, all right? So building materials are up since COVID. These are primarily due to supply chain choke points and inflation, all right? Now, Mr. Trump has imposed even further tariffs on them. And remember, a lot of this stuff comes from China, too, all right? Lumber is Canada. A lot of tiles from Mexico, but steel and finished metal products, again, your faucets and your doorknobs, often from China. All right. So what happened during the last depression? Well, we had something called Smoot-Hawley. You probably heard it on the news. There were two U.S. senators back in 1929 that told Herbert Hoover, who was president, that he needed to respond to the stock market crash by taxing other countries. So the stock market crashed in 1929. That meant revenue dropped, particularly from the income tax, because 25% of our workforce was unemployed. If unemployment rate's 25%, believe me, your income tax revenue is going to plummet. So President Hoover wanted a way to make up for it. So Senator Smoot and Senator Hawley said, we have something called tariffs. It's like a tax on other countries. So we'll tax other countries, which is certainly more politically popular than taxing our own citizens, and that'll generate revenue for us. By the way, is that speech sounding familiar to you at all? Or that logic? Okay. Well, what happened with Smoot-Hawley? So this is one of the most famous charts in international economics. It's called the Kindleberger spiral. You notice it looks like a spider web. So it's named after a professor of economics, Dr. Kindleberger. He tracked the total volume of world trade starting in 1929 when Smoot-Hawley was enacted. And he looked at how it contracted over time, because what other countries did after we enacted our tariffs is they enacted retaliatory tariffs, to which we responded by raising our tariffs even higher. And they responded by raising their tariffs higher. Again, is this sounding familiar to you at all? Well, what happened? So in 1929, when Smoot-Hawley was enacted, the total volume of world trade was about $3 trillion, okay? Here it is contracting over the course of the next 12 months. By 1930, the year 1930, world trade volume had contracted to 2.7 trillion. Keep following the spiral. By 1931, it was now 1.8 trillion. Keep going. By the time we hit bottom in 1933, 4 years later, world trade had contracted to less than $1 trillion. All right. So that is a 66% contraction in world trade volume. World trade volume, the total dollar volume of traded goods and services fell by 2/3. And that caused the Great Depression. Originally, we were going to have a recession due to the stock market crash. But now most economists, whether they're politically left, right, or center, blame Smoot-Hawley for taking a recession and turning it into a depression. Again, is any of this sounding familiar to you from what you're hearing on the news? Because it should. So what does that mean? So we've got a drop in the stock market, but then on top of that, we're going to layer tariffs, which is going to increase building materials on top of the already large increase in the cost of building materials that have happened since COVID. So not good. What does that mean in numbers? All right. So if history's any guide, Smoot-Hawley caused the S&P to drop by 66% from 1929 to 1933. If Trump's tariffs persist for that long, 4 years, that would imply a house price drop of 58%. All right. Remember, peak to trough in our region during the Great Recession, house prices fell by 23%. If you take a stock market decline and then layer in increase the effect of tariffs on building costs, that would imply a drop in house prices nationally of 58%. That is a huge decline. Remember, the national drop in house prices during the Great Recession was 34%. So that is going to be a Great Depression. Right? Well, we'll have to call it the Greater Depression, or maybe the Greatest Depression. Now, I'm not saying that's going to happen, so don't freak out. I'm just saying that if history is any guide, that would be our worst case scenario. So if we have a stock market decline, or it's going to continue, and Mr. Trump's tariffs are going to continue for an extended period of time, not just a few months. It would have to be a few years. And other countries are not going to blink like he's gambling that they will. They're going to, impose retaliatory tariffs. We would have a very, very bad national recession, and we would also have a significant housing downturn. So you would expect that in prices. Again, I want to emphasize that's my worst case scenario, and it is worst case. We've already seen a rebound. I don't know what the market's going to do today. We've seen Mr. Trump say put a 90-day moratorium on the tariffs for almost everyone except China. What's China going to do? I have no idea. I wish I did. If I could, I'd be a millionaire by now because I could speculate in currencies and bonds. Instead, I'm here with you fine people, which I would prefer anyway. So that's my bearish segment. All right, that's if history's any guide, that would be our worst case scenario. So I don't want to leave you with that many qualms. So let me conclude on a somewhat more optimistic note. First of all, right now, the markets are saying that the probability of an actual recession occurring is increasing, but it's still fairly low. So there's something called the Sahm rule, which is discovered by an economist named Claudia Sahm. And she found that sudden, very sharp upticks in the unemployment rate are usually very good leading indicators of a recession. So here's the value of her index going back to 1960. And the value in the gray areas, again, are recessions, right? So here's the tech bubble recession. Here's the Great Recession. If you squint, you'll see the COVID recession. But notice that every time a recession has occurred, the blue line goes up. That's her indicator. Here's where we are right now. So if you're hovering around this black line, you're in good shape. It means the markets are not expecting a recession. Starting to go up. Now, this does not take into account the S&P's movements in the last week because this is taken monthly. So maybe in another month, you'll see this spike. But right now, the markets have not capitalized, or at least are not expecting a severe recession. Whatever pain we might be going through, they view as short term. So far. So that's encouraging. All right. Zillow has also become more bearish, but again, they're not in full-blown panic mode. So Zillow forecasts house prices for every major metro area over the next 12 months. Right now, Zillow is forecasting below average growth, but still positive growth. They're not predicting a downturn. Now, this forecast is prior to the past week. This forecast is several weeks old. All right, so they update it quarterly. So their latest quarter may become more bearish. Zillow has generally been becoming more bearish on housing in general, and especially in the Northeast and the Great Lakes. Sun Belt a bit different. So right now, they're projecting an increase in house prices in our region of 1.6% over the next year. Remember, house prices historically have grown by about 4.5%. So they're projecting below average growth, and they're definitely projecting a cooling off since COVID. I mean, we were growing by 15% per year. Now Zillow's saying, well, you can expect growth of 1.6%. That's a downgrade from 3 months ago. They were forecasting 2.6%. So Zillow is becoming increasingly bearish on house prices in our region. But again, not full-blown panic mode, just a cooling off, a leveling off, which I don't view as a bad thing because I would like a cooling off so that incomes could catch up with house prices and affordability would become less of an issue. And then that would put us in a more rational market. I mean, high house prices are great if you're working on commission, but if nothing's changing hands because everything's unaffordable, well, then you're not making your commission. So I would imagine many of you, if not most of you, given a choice between house prices continuing to grow, but the volume of transactions plummeting because housing is unaffordable, you'd rather have house prices moderate, but make it up on more transactions, right? At least I would think so. I don't know. You can tell me that. That's for you to decide. All right. So wrapping this up, what should you expect going forward? So here's my predictions for the remainder of 2025. And by the way, most of these predictions are prior to the tariffs, but I'll conclude on that. Absent a recession or a trade war, I think rates will remain largely flat. Okay, we might see one modest cut in 2025. But again, that's absent a recession or a trade war. All right, so don't expect interest rates to save you in 2025. But if the stock market remains volatile or even drops and a recession occurs, the silver lining of that is you can expect rates to drop. So the silver lining for housing is that when the stock market's declining, you enter a recession. First of all, you have capital flows from equities, which is the stock market, into debt, which is the bond market. Okay, when money flows into the debt markets, that drives yields down because prices of bonds go up because money is flooding the bond market. So that pushes prices up. And when bond prices go up, yields, which are interest rates, go down. Okay, so the silver line, and also when a recession occurs, unemployment goes up. And as I showed you earlier, what happens when unemployment goes up? The Fed feels comfortable in lowering rates. So insofar as tariffs cause a stock market decline and they cause a recession, the silver lining of that for you is that you can expect rates to go down. Okay. The problem is that people are going to be poor. And what's more, they don't want to buy houses when the stock market is plunging because a lot of their wealth is tied up in it. Plus, they're just bearish about the economy. So they may their mortgage payment may be going down for most buyers, but they've got to get comfortable with buying a home. So in our worst case scenario where we do go into a recession and the stock market is not offering decent returns, your work will be convincing buyers to buy, getting them comfortable in buying, as well as convincing sellers to get comfortable with selling. But I would not expect, currently the forecast is for a cooling in house prices, not a plunge. So get some marketing materials together that say, well, the silver lining of all this is that rates are down. And what's more, eventually the stock market always recovers, and so does the economy. So make your move now. You might have a year or two where you're not building much equity in your home. But once things get better, then rates are going to go up and you're going to miss that train. Okay, so get your marketing materials geared to address that concern and to tell that story. Third, I think in the multifamily market, we're going to have to deal with a glut of new construction, particularly in very specific zip codes in the city and the suburbs. And offices are going to have to still deal with the return to work. They're still trying to woo people back. Again, with a lot of leases expiring, that's going to force a lot of major tenants to make some major decisions about their size and location. Do they want to lease as much space? And do they want to lease as much space in the city? I think inventories, the amount of homes listed for sale will continue to slowly rise. But I think home sales activity will remain largely flat, again, as long as rates remain where they are and inventories are relatively slow and demand is slackening due to uncertainty. I would expect home sales not to plunge, but still remain trending flat, which again, I don't necessarily view as a bad thing because I don't expect them to plummet. So in general, I would expect the housing market to be reverting towards its mean, where we have a more balanced market between buyers and sellers, and prices are more rational. So just sort of a general leveling off, if you will, in the market. Not a crash, not a boom, but a leveling off. But again, the bottom line, I wouldn't normally expect a stable year, but there's the Trump factor. Please don't ask me to predict what Mr. Trump is going to do. No one can predict that. He is the wild card in this. I would imagine you would agree. Whatever you think of him, good or bad, he is a very uncertain guy in the sense of there's a lot of uncertainty surrounding his next move. So I'm not going to predict what his next move will be, but I know that whatever he does will be capitalized into the markets. And I don't just mean the stock market, but the housing market as well. So what else? Well, on a lighter note, As you know, in real estate, naming besides location can be everything. So we're speaking of Mr. Trump, I would expect a few changes in names to the geography of our hemisphere. So here's the Western Hemisphere. As we all know, here's America. America will remain America, but Canada will become Northern America. Greenland will become really Northern America. Mexico will be renamed Worse America. South America will be renamed Worse Mexico. The Panama Canal will become the Panamaga Canal. And I know he wants to call the Gulf of Mexico the Gulf of America. I think he'll change it to the Gulf of Trumpistan. And last but not least, I think Gaza will be renamed East Bronx. So with that, I say thank you very much. I hope you have a great year, and I'd be happy to take any questions that you have. Matthew, are you there?
All right. Yeah. Any questions from anyone? All right, Kevin, thank you for
It was that
sharing all that.
comprehensive, or was that boring?
Yeah. No, hit a lot, and we had a lot of folks on here for the vast majority of today's presentation. So
I have a question. I'm sorry to interrupt.
Go ahead.
I know you mentioned regarding like where the new home buyers were going to get money from for down payment, closing costs. With the city's initiative and the state's initiative to put up so much money for grant money through K-Flex, K-Fit, Philly First, First Front Door, all of these grant programs that are, some of them are income driven, some of them are not. I even seen some banks have their own in-house grants between 5, 10, 15,000. How is that? I didn't see where that was like equated in what you mentioned about like where the money was coming from for first-time home buyers. How much of an impact do you think that's really making on new home buyers buying homes?
That's a great question. I'm aware of those programs as well. I have not undertaken any empirical analysis. My sense, though, is that the impact would at best be modest. First of all, people have to become aware of these programs, and I don't think they've been marketed as much as they could be. But also on top, there's what we call the compliance costs. So you've got to provide all sorts of documentation to qualify. And many low-income households, I mean, they don't keep past tax returns and things like that. So they're going to have some work to do assembling the paperwork on that. And they also, I would imagine, need some help and some guidance. But, that's what, realtors, you specialize in that stuff of, holding people's hands through the home buying or home selling process. So if I were you, I would actually assemble some marketing materials on exactly these programs, especially if you sell in the city, particularly in the low mod income areas of the city, that list these programs, what you need to qualify, and then help prospective buyers and sellers walk through those programs to see which ones they might be a fit for.
Thank you. I appreciate it.
My pleasure. If anyone has any questions, you can see my email address. Feel free to ping me there. Do we have any other questions, Matt?
No, we had a lot of compliments in the chat, so that was great stuff. And yes, this is recorded and will be put up onto our YouTube channel, and that is at Philly Realtors. We'll send a message out to all members as well when that gets posted onto our page. But if you subscribe to us, you will miss none of our postings. So that's a great way to make sure you know what's going on and what's been posted if you happen to miss one of these great sessions. So Kevin, any last thoughts before we close up?
Yeah, pay close attention to everything. I mean, that I don't mean me. I mean, what's going on in the news. Bring me back in a few months and I'll let you know where we're at.
All right. Sounds like we have a promise there to see you in a few months. All right, guys. Everyone have a great day. Thanks for joining us. Thank you, Kevin. Take care.
Thank you, Matt.
Thank
Thank you,
you.
GPAR.